Well, just yesterday we received some new data and we're seeing some major changes, leading some experts to claim that not only will we see inflation decrease in the year to come, but that we could actually see deflation in the coming years. This viewpoint could have some major impacts on you directly in areas like real estate, your investments, and the cost of living here in Canada. But along with these potential impacts, it's important to keep in mind certain warning signs that we're going to need to keep our eyes open for over the next year. So let's talk about this new inflation data, the argument for deflation, a situation where we could actually see the price of goods and services go down over time, and some factors that directly conflict with that idea, and how you can use all of this information to potentially benefit yourself. So let's get into the information and make sure to subscribe to the channel if you haven't already done so. So we just received the new CPI data, or the Consumer Price Index data, and this is what tells us like how fast inflation is affecting Canadians. As of last month, we sat at an inflation rate of 6.8%, but now this month it came in far lower at 6.3%, but still obviously way too high for the Bank of Canada's liking, who would like to keep this between 1 and 3%. But this 6.3% increase in the cost of goods and services in Canada doesn't really give us a clear picture as to the current trend that we are on, because this number is compared to an entire year ago. In the past 3 months, and the trend that is sort of setting is telling quite a different story. This visual shows you each individual category of the Consumer Price Index and which way prices have gone over the past 3 months in each of these categories. Anything that is green is increasing at a rate that is 2% or less, or even potentially decreasing. And then when we get into those red shades, those are areas where prices are increasing at a rate faster than 2% per year. When we look at the elements of this chart that are most increasing inflation, we can see that the largest impact is mortgage interest costs right here. And that's something that's actually controlled by the Bank of Canada. If they raise interest rates, then the cost of paying your mortgage, the interest on your mortgage, is of course going to go up, which is what's happened here, a 36% increase in mortgage interest costs over the last 3 months. Taking into consideration this shorter 3-month trend and sort of adding all of these boxes that you just saw together in the same way that the CPI number is calculated, you can more clearly see this trend. Let me show you what I'm talking about. Here's a little chart I put together that I think will make things a lot more clear as to the point I'm trying to get across. These numbers here are the month-over-month increases for inflation over the past 3 months of data. So when we're looking at October, we see that, okay, inflation was 0.7% higher than in the month of September. And when we look at November, we can say, okay, inflation was 0.1% higher in November than it was in October, trending up. But then when we take the most recent data into consideration, December, and compare that to what it was in November, we see that it has actually come down by 0.6%. So when you take all of that data together, these 3 individual months of month-over-month inflation data, we can see that the 3-month trend over the past 3 months is that inflation has increased at a rate of 0.2% per 3 months. Or if we annualize that out, sort of looking at this trend, and if we were to extend that across the entire year, well, then we'd actually be looking at only 0.8% inflation. Now that 0.8% inflation, if we were to see that, that would actually be on the other side of the Bank of Canada's target, and they'd actually consider that too low a rate of inflation. They aim, again, to keep it between 1 and 3%, targeting 2% as their ideal inflation rate. That's what's leading some experts to believe that it's more likely that over the next year, year and a half, we could be in a period of either stagnation or even cross over that line into deflation, saying that we may have gone too far in terms of how far we've increased interest rates and how that could lead us into a recession. And there is some rather shocking data that explains why this might actually be a possibility here. This chart shows us the M2 in America. This is looking at the US specifically right now, and we'll sort of switch over the lens to Canada and a similar chart to this in just a moment. Now, the M2 sort of describes the amount of money in the economic system. I won't get into too much detail on how they calculate M2, but it includes bank deposits as well as circulating cash and other financial instruments, and many people point to it as a measure of, again, how much money is in the system. Now, at the beginning of the pandemic, when the economy needed a lot of stimulus, the Federal Reserve, the sort of counterpart to the Bank of Canada in the US, they turned on the money printer, did the same QE, quantitative easing experiment that Canada participated in, and created a whole bunch of money, up to 22% per year, like growth at Monday, May 18th, when that was measured. Now, of course, this is a historic period where our money supply grew extremely quickly, but when you look back around the sort of average rate of year-over-year money supply growth, we can see that it hovers anywhere between the 5 to 7, 8, 9% range. So that's kind of what you would expect to see over the long term, is just a slow and steady growth of our money supply. Of course, the pandemic shot it up and went extremely quickly, but what we have not seen, at least since 1995, is seeing this year-over-year money supply growth actually go negative, and that's what we're seeing as of today with the latest data, Monday, December 5th, seeing actually a year-over-year decrease in money supply to the tune of 0.73%. Many people believe that one of the chief reasons we saw so much inflation is that we created so much money during the pandemic, and that led to more money chasing the same amount of goods, driving up prices. But what happens when we enter a period where there is less money in circulation, less money in the system than there was in previous years, and actually declining at a way faster rate than what is typical, right? Here's what the fund manager Kathy Wood had to say about this situation, where for the first time since 1995, and even that was just a blip, we're actually seeing a decline in money supply instead of steady growth around 6 to 9%.
M2 is now down to zero growth on a year-over-year basis, and that's as of November. It does look like November went negative, and we believe the negative growth rate will continue, if not accelerate to the downside during the next 3 to 6 months. This is a very unusual period. In fact, in my career, I've never seen it go negative, and I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. That when I say uncharted territory, if you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. So zero negative is a huge departure, and we believe highly deflationary. And we're beginning to see that.
So that's certainly some interesting insight as to how uncommon a decrease in the money supply is. Now in Canada, we're not in the exact same situation, but we're in one that's rather similar. This is the exact same chart, but just for Canada, where it shows you the average money supply growth year over year for every individual year. And you can see this sort of sits around 6.6, 6.7, 7, 8, this sort of range, getting down to the sort of high fours during this tightening cycle when the Bank of Canada was raising interest rates. And you can see the same dramatic increase where our money supply grew 14% in just 1 year. And you can see the trend downward, very similar to the US, where we're only at 4.4% year over year money supply growth. And it seems like this could cross over into negative territory based on the current trajectory. So for those that believe that printing money and adding more money into the system, no matter how they do it, be it through quantitative easing or other methods, well, you likely would believe similarly on the other side that removing money from the system could in fact be deflationary instead of inflationary. And it also seems that stock market investors think that we've seen the last, or at least the worst, of inflation, both in the US and Canada. You can see here that over the past year, the S&P 500, which is sort of a representation of the largest companies in America, well, though investing in those stocks has netted you minus 13.32% over the past year, largely because these companies and the investors think that the banks, the central banks, will continue to raise interest rates to fight inflation, which traditionally is not very good for companies. Now, when we shift to now that we've gotten sort of this downtrend and we look at the, in terms of inflation, and we look at the year-to-date performance of the S&P 500, well, we see a 2.74% increase. And I think that this could signal that investors believe, okay, we're through inflation. It's likely that the Federal Reserve and the Bank of Canada won't dramatically increase interest rates anymore, and we could actually see a turning back on of the monetary policy stimulus stimulus that we saw at the beginning of the pandemic, albeit not to the same extent, of course. So those are some rather convincing arguments that we could see a stagnation or even deflation in Canada over the next couple of years, but others believe that maybe inflation is going to be a little bit more sticky for a number of different reasons. And one of those arguments is that, well, we could be in an era of deglobalization instead of globalization. Now, this sounds complex, but it's rather simple. People believe that globalization, or using labor from other parts of the world, using supply chains from other parts of the world, has largely been deflationary, right? Lowering the cost of goods because we can use cheaper labor and use faster supply chains that are, albeit less strong, but extremely quick and extremely efficient and cheap. Now, after the pandemic and the havoc that wreaked on our supply chains, many people are going towards sort of something they're calling friend shoring, where they only really use supply chains within a close, tight-knit circle of individual countries. Now, this means that things are going to be more expensive. This is an inflationary pressure, deglobalization, because it means supply chains are more expensive, less efficient, and, well, labor costs are higher when you sort of onshore your labor expenses, right? Now, this chart tracks that trend of globalization, and it says for the entire world economy, what percentage of that is from exports and imports with other individual countries rather than keeping it all domestic within your own country. And we can see here that perhaps this has peaked just above 60%, maybe around 62% of the world economy represented by trade with other countries. And we can sort of see that, well, we might be headed on a downtrend here as countries are more hesitant to rely on others for their goods and services. So there are opposing points of view here, and no one really knows what's going to happen, but how can you use this information to set yourself up for success? Now, when we're talking about the individual markets that you could invest in, if inflation is actually going to continue this downtrend, and if we even hit a deflationary period, it would be likely that that would be a good thing for markets, because the central banks could provide more stimulus to the markets, a drug that they've become addicted to. However, like I said, nobody has a crystal ball, and nobody really truly knows which direction things are going to. We can just look at the information, much like the information I've laid out in this video, and make our best guess. However, I think that the best bet when it comes to investing is more to dollar cost average into the markets, or invest a little bit over time here and there so that you get the sort of average direction of the market, especially investing in things like index ETFs that give you broad exposure to multiple different assets and asset classes. But I'm curious what you think. Inflation in Canada right now is sitting at 6.3%, which obviously is a lot too high, but do you think that we're through the highest amounts of inflation we could be entering into this deflationary period, or do you think that that's a crock and then it's likely that inflation will remain high over the long term? No matter which way you think about it, let me know down in the comments below. I read every single one and try to get back to a bunch of them, and if you want the sources that I've used for this video, I send them all out at the end of the week. You can check that out in the first link in the description, and subscribe while you're down there if you haven't already done so and you find these Canadian-focused financial updates helpful for you. But with all that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.